What's up guys, welcome back to the Daily Stock Picks, and in this video we'll be going over 9 Outbreak fuel stocks to buy this week according to this article by Investors Place. So what I'll be doing for you guys is reading over this article with my beautiful voice, commenting, and we'll be conducting my own quantitative analysis to see whether these 9 companies either belong in our dividend portfolio or our value portfolio by using this checklist. So if you guys really appreciate me doing this, saving you guys heaps of time reading this article and doing the analysis for you to get your research started, make sure that you smash the like button for the YouTube algorithm. I would really appreciate it. And now, without further ado, let's get this video started. So 9 Outbreak fuel stocks to buy this week. Inoculate your portfolio with these best stocks for the week by Josh Inamoto, Investor Place contributor. 4. President Donald Trump's administration declining novel CVPD cases couldn't have come at a better time. After all, had the Republican National Convention occurred in mid-July, the idea that the White House responded quickly and effectively against the CVPD pandemic would be difficult to swallow. Still, that doesn't mean you should be complacent about the Outbreak fueled stocks to buy this week. For one thing, it's likely that history will look back on this crisis and blame complacency as one of the big contributors. While cases were minimal and when we had no deaths was a time the US government should have implemented mitigation protocols. Instead, some critical delays turned the crisis into a conflagration, one that has caused severe problems in our economy. Second, as schools reopen, many students are falling ill. As CNBC reported, several academic institutions saw rapidly spreading CVPD, spoiling carefully designed plans to safely bring students back to the classroom. Therefore, investors may want to consider the education sector for viable stocks to buy this week. Adding to this pandemic woes, Mother Nature really has in it for us this year. On the eastern side of the United States, we have a record-breaking hurricane season that could easily worsen. On the west coast, we have a sweltering heat wave that is heaping misery on Americans who have been looking forward to piecing their lives back together. Thus, the stocks to buy this week were an eclectic bunch, okay? So, I know 2020 has been, might be the worst year so far. Like, there's a lot of things that are happening, and on top of that, the CVPD is just adding more pressure to it, and the unemployment is at an all-time high despite the stock market going in the reverse because of the Fed pumping in so much money into the economy in order to prevent a recession. So these are the 9 companies that we'll be going over in this article, according to which was written by this writer. So for maximum utility, I've separated these companies into 3 categories with 3 stocks each, high probability names with limited upside, and a balanced approach between upside potential and risk, and finally the downright speculative trades. Although a calmer period than other weeks we've had, we can't let our guard down. Therefore, it's important to still protect your portfolio with these relevant stocks to buy. So that's good because they did most of the work for us. They divided the portfolios into 3 categories, but let's see which one of these either belong in our value portfolio or our dividend portfolio. So the first company in this list is Abbott Laboratories. So thanks to the federal government's Operation Warp Speed, this private-public partnership has rapidly accelerated the push for a CVPD vaccine. Typically, a vaccine takes years to bring to the market. However, the Trump administration hopes to get one out to the public before the election day. Obviously, this universal demand drives the case for stocks to buy this week in biotechnology space. Okay, so however, just like the virus, gambling on the sector has been brutal. For conservative investors that still want exposure to a potential solution, you may be better off with Abbott Laboratories What I like about ABT stock is that it's levered to a relatively unappreciated component of our CVPD battle: diagnostics and testing. Without testing, our frontline workers are really operating in the dark. Recently, that's exactly what medical experts bemoaned. Without a robust network of testing, it's hard to know how to combat CVPD hotspots. Therefore, expect ABT stock to have an extended upside pathway so long as we're dealing with this pandemic. Okay, let's have a look. So, in order for a company to meet our dividend portfolio, it needs to meet 4 criteria that I have formulated based on reading these 3 books. So, the first book is Dividends Still Don't Lie by Kelly Wright. The second book is Get Rich with Dividends by Mark. And the third book is The Ultimate Dividend Playbook by Josh Peters from Morningstar. And the 4 principles are: rule number 1, the current free cash flows must be positive. So we want to be looking at companies that have a positive free cash flow so that we can rest assured sleep well at night. You know what I'm saying? And rule number 2 is that the dividends paid out should not be more than 75% of the free cash flows. And rule number 3 is that the companies need to have a consistent dividend growth history of at least 5 years or more of growing their dividends. And rule number 4 is the buying criteria. We only want to be buying the stock when the current dividend yield is more or greater than or equal to the 5-year dividend yield average. More on that later. Let's have a look at the visual aspect of it. So now looking at the first company, that is ABT. We can see that the price to earnings ratio is nearly double the S&P 500 index. So it's no way on a discount when compared to the price to earnings ratio. But let's see about the dividend conditions of this company, ABT. I like to use Y charts because they do a really good job of representing the data in a graphical format rather than looking at boring old numbers. So looking at the revenues have been decreasing over the past 10 years and it's been fluctuating a lot. And the free cash flows, as you can see, it is positive, but it has been falling down over the past 10 years. Because back in, I believe, 2010, it was around $7.72 billion. Now it's $4.9 billion. So as time goes by, we want to be looking at companies that are able to increase their free cash flows. And let's have a look. It does pay out a dividend. It has been paying out substantially. Let's see if it meets our minimum criteria. 2.27 divided by 4.498, meaning that it's paying out 50% of its dividends, of its cash flows as a dividend to its shareholders just by owning the stock. And let's see how consistent it has been paying out its dividends for its shareholders, or like how, by what percentage has it been growing its dividends. It's just loading a little bit. So the company has been growing its dividends for the past 7 years at a rate of around 7.78%. That is pretty good. It definitely does meet our criteria, but we will be looking at more aspects of this as well. And the right time to buy the stock is when the current dividend yield is more than the 5-year average dividend yield. By going into Y charts and clicking on dividend yield and typing in the ticker symbol of the company, we can see that the current dividend yield for this company is 1.26, and the 5-year average that we can see here is 1.93. So we want to be buying this when it is more than 1.93. Because of this particular condition, it doesn't meet our dividend portfolio. So you want to be buying it when it's at a discount. Just for the fun of it, let's see, back in, I believe, March of this year, it was trading around 1.77. Still wouldn't have met the criteria, but maybe in 1.93. Let's have a look. Yep, in October, maybe October of 2017, this dividend yield was around 1.92. September, October-ish 2017. Let's see what the price would have been back then. The price would have been somewhere around $40. 40, let's see, $50. So the company would have nearly doubled your investment in the span of 2018, 2019, 2020, in the span of 3 years. So that's more than 30% year over year on your investment if you decided to buy this company back in 2017. I know, but we did miss our chance here. But not to worry, we can still see if the company does meet in our value portfolio in order to buy it right now. So in order for a company to meet my value portfolio, it needs to meet 5 rules. The 5 rules are based upon the 3 books that I've read. The New Buffettology, which is written by Mary Buffett and David Clark. Mary Buffett is the daughter-in-law of the Oracle of Omaha, Warren Buffett. The second book is Rule Number 1, Investing by Phil Town. Pretty good read. And the third book is The Little Book That Still Beats the Stock Market by Joel Greenblatt, where he goes over his infamous magic formula. And the 5 principles are as follows. Rule number 1, the return on invested capital must be greater than or equal to 10. So what that basically means, it's basically a big brother of return on equity. So for every $100 that we're able to invest into the company, we want to be making sure that the company can at least give us $10 in return. So there are some cases which I consider if it's less than this, but they would be having phenomenal balance sheet, like their financial statements, for me to arrive at that conclusion. Rule number 2 is that it needs to have consistent net cash flows. Rule number 3 is that it needs to have a strong balance sheet. And rule number 4 and rule number 5 are our buy criteria. So if the current price is less than 80% of the fair price, we would want to be buying the stock. And rule number 5 is if rule number 4 doesn't meet the criteria, we'll be going to rule number 5. If the current price to earnings ratio is less than 50% of the highest price to earnings ratio over the past 5 years and lesser than the S&P 500 index, we would be considering to include the company in our value portfolio. Now, coming to this, we know it definitely doesn't meet our dividend portfolio, but let's see the value portfolio criteria. ABT. So the return on invested capital is 7.39. Nothing to rave about, but I did see some years previously where it's about 10. And the free cash flows in these analysis we've already done in our dividend portfolio calculation. Now let's have a look. The net cash flow seems to be pretty okay, but I wouldn't say that it's really good. It's sufficient to cover its dividends. Now let's have a look at the balance sheet criteria. So we can see on the balance sheet the total long-term debt is around $20 billion and it has a current assets of $17.22 billion. So what this means is that current assets are basically the assets that can be liquidated into liquid cash within 12 months or less. So if you deduct this by this, it will have somewhere around $3 billion of long-term debt. And if it chooses to pay it off, it can pay it off within 2 years from its free cash flows by considering this. Based on this, I would particularly say that it does have a pretty good balance sheet. Now let's go on and calculate the intrinsic value of this particular company. So the earnings per share is $1.73. Now we want to be looking at the price to earnings ratio. So one is 12.45, the other one is 254.16. So the average is going to be 133.31. Now let's see what the growth multiple that we should be using for calculating the intrinsic value. According to Y Charts, they're estimating that Abbott Laboratories is going to be growing at a rate of 11.53. And the multiplication factor is going to be the minimum of these two. So it's this multiplied by 2, it's going to be 23.06 as the multiplication ratio. So we want to be on the conservative side when we're looking at the price to earnings multiple. So what this Excel calculator or Google Sheets calculator is doing here is we're basically projecting this earnings per share estimate over the past 10 years. Okay, once the 10 years time goes on, we will be arriving at an earnings per share ratio. With that, we want to be multiplying with the price to earnings ratio at which we might think that the company might be trading at in order to get our intrinsic value. So In order to be on the conservative side, we want to be selecting the lowest one, which is 23.06, which is the analyst estimates times 2, right? So 10 years from now, if you were to look at this growth projections, we can estimate that the intrinsic value is going to be around $106.52. And if you were to discount it back to the present day, considering a 15% return on invested, on like 15% return, year over year return, we should be buying the stock when it's around $30.28, right? But looking at the criteria and all the situation here, we never want to be paying the sticker price here. We want to be paying less than the sticker price. So the right price would be $15.14, which is pretty low when compared to this size, because investors are willing to pay a lot more when compared to the S&P 500 index because of its growth potential that it has. But even if you want to be considering this based upon a pure calculation, we want to be buying the stock when it's around $24.22. So as a result, it definitely didn't meet our rule number 4 in the value portfolio, but we can definitely see if it meets the rule number 5 to see if we can buy this company at this stage. So the current price to earnings ratio is less than 50% of the highest price to earnings ratio. So the highest price to earnings ratio was 254 over the span of 5 years, and the current price to earnings ratio is 63.51. So it definitely does meet the criteria here. And is it lesser than the S&P 500 index? Unfortunately, no. As a result, we wouldn't be looking at investing in this company either in our dividend portfolio or our value portfolio due to this reason. So not too shabby. Don't get disappointed. We do have still 8 more stocks to go to see whether these belong in either one of these portfolios. So the next company in this list is Lowe's Company, ticker symbol LOW. Though I wholeheartedly believe that investors should direct their research on stocks to buy towards key essentials. That does not exclusively involve nourishment. Rather, it's the little things that we take for granted that goes wrong during an emergency or a crisis. And that's where Lowe's Companies really shines. As a personal antidote, I thought I had all my bases covered for this pandemic: food, water, and more toilet paper than I've ever bought in one sitting. But when one of my light bulbs went out, I knew immediately that my planning was not quite adequate. Given that some of the essential items fall through the cracks, people are quick to purchase them. Naturally, this bolsters the case for Lowe's stock. Also, let's not forget the nature doesn't give a hoot that we're suffering from a pandemic. As several media reports have indicated, we're expecting a record-breaking hurricane season this year. So yeah, 2020 stinks, but you can mitigate some of your pain by buying low. I know Low stock because I did analyze this company on multiple occasions. This is a pretty good buy. Let's have a look. And it's definitely a part of our dividend criteria. So Lowe's company revenue has been increasing substantially, along with its free cash flows, though it has been having a little bit of iffies here and there. And it currently has a free cash flow of $2.812 billion, out of which $1.618 billion is being paid out as a dividend. So free cash flows are definitely a positive. Let's have a look at Lowe's price to earnings multiple. So definitely cheaper when compared to the rest of the broader market. Now let's see if it's paying less than 75% of its free cash flows. 1.618 divided by 2.812. So around 57% of its free cash flows is being paid out as a dividend. So the remaining 43% of it can be reinvested back into the business by the management so that it can increase the stock price by increasing the revenues and the top lines and the bottom lines. So definitely meets this criteria. Let's see how long Lowe's has been paying out its dividend. Looking at Seeking Alpha, we can see that Lowe's has been paying out its dividends over the past 31 years, and it belongs to a unique class of dividend paying stocks called the Dividend Aristocrats, which have been increasing its dividends for more than 25 years. So it's even more than my age. So this company has been increasing its dividends, and it's been increasing at a substantial rate, guys, at around 19.39%. Just imagine you going to a job and just by attending the job, you're able to increase your salary, like the management or the company increases your salary 20% year over year. And that Lowe's management is doing that for you, or the company is doing that for you just for owning this freaking stock. So which is pretty substantial. I really love this particular criteria. And now we want to be checking whether it's the right time to buy this company. So for that, let's open up the dividend yield for Lowe's stock. As we can see that the current dividend yield is 1.33 and the 5-year average dividend yield is 1.72. So we want to be buying the stock when the current yield is more than the 5-year average, so that we know that it is trading at a discount, right? Based on the current circumstances, it's not a buy criteria because it is lesser than the average dividend yield. Just for the fun of it, let's have a look. Back in March, when the whole pandemic situation started to worsen and investors went for the hill, it was trading around 3.28% dividend yield. And looking at the low stock price at that particular time frame, let's see how much the capital appreciation would have happened. Not on top of that, you would have gotten around 3% as a dividend yield, like 3% just for owning the stock as like a bonus. And coming to this, $73, you would have nearly doubled your money in a span of 4 to 5 months just by owning the stock, which would have been a great opportunity which we just missed. But not to worry, let's see if this company belongs in our value portfolio. Ticker symbol LOW. So the return on invested capital, pretty good, 20.81, substantially well, bravo. Free cash flows, we've already analyzed this. Let's have a look at the balance sheet. We can see that the total long-term debt is around $21 billion or 22, and out of which $27 billion is in current assets, which can pay it off immediately. If the management chooses to do so, it can pay off its long-term debt immediately in the snap of a finger, or Thanos snap, right? So the balance sheet is also pretty phenomenal. Now let's calculate the intrinsic value of the company. So 7.52. Now let's have a look at the price to earnings ratio to see what range it was trading at over the past 5 years. So Lowe's stock, the price to earnings ratio is 11.89, 41.85. And the analysts are expecting the stock to grow at, am I saying numbers? They're just saying that it's going to grow at somewhere around 21.80%. So we want to be like more on the conservative side and consider the multiplication factor of less than, whichever is the less price to earnings multiple. So it will be 26.87 in this case. We'll be taking the price to earnings ratio directly because the earnings estimate, the prior multiplication factor would be coming around 43, which is a little bit optimistic. If it does happen, hey, more power to you. We'll be getting more bang for our buck, right? So based on the minimum and the conservative estimate, the intrinsic value of the company 10 years from now is going to be somewhere around $1,192 if the company can grow at this particular level. And discounting it back to the present day, the sticker price, or the price that we should be buying the stock, considering a 15% return on an investment, is $338.87. And the right price to buy it is considering it a 50% discount, which is $169. So I'm so happy because we're about to get a 50% markdown on Lowe's stock, considering the growth rate and the projections for this particular company, right? So as a result, it definitely does meet our price criteria, and you should be consider buying this stock right now. So let's have a look. Google Finance. This is just basically a formula that brings out the price for this particular portfolio. So not a dividend portfolio criteria, but definitely a value proposition in terms of rule number 4. And let's have a look at rule number 5 as well. So you want to be buying company when it's the current price to earnings ratio is less than 50% of the over the past 5 years. Since the rule number 4 already met, we don't want to be looking at rule number 5 as well because it didn't meet in this particular criteria. Overall, it's lesser than the broader market. At a discount, you're nearly getting a 50% discount rate on low stock. So happy that we were able to get at least one company from this list, and we haven't even reached till the end of the video. So this writer is pretty good in terms of like calculating the information and everything like that. So props to this guy. So the third company in this list is Pool Corp, ticker symbol POOL. As I've mentioned above, a blistering heat wave has struck the West Coast, further compounding the issues we face with the CVPD. In California, many residents became victims to sudden rolling blackouts in order to save the electric grid, a first since 2001. Not surprisingly, Pool Corp has seen an uptick in its equity valuation recently. According to its website, Pool Corp is the world's leading independent distributor of swimming pool supplies, with an additional focus on irrigation, equipment, outdoor living, and landscape products. Looking at the forecast for major cities in California, it looks like the record temperatures aren't done torturing us. Therefore, I anticipate further interest in Pool stock. Of course, there's a risk in putting Pool Corp into this list of stocks to buy this week. Mainly, it's an awfully reactionary move. However, Pool stock is levered to a wealthier demographic that can afford the underlying services, and there's no better motivator than pain, if I'm being completely honest. Okay, let's have a look at Pool stock, POOL, 47.21, not at a discount when compared to the S&P 500 broader market. Let's see if this stock belongs in our dividend portfolio. So ticker symbol POOL. Okay, not too shabby. Revenues, almost as like a straight line. You can project this revenues even into the coming 10 years. The free cash flows, $85 million. Now it's around 265. So I would say around 1.5 doubles. So around 15% increase in its free cash flows over the past 10 years, and dividends it's paying out. So free cash flows are definitely a positive. Let's see if the dividend is less than 75%. 83.77 divided by 265.41. So around 30% of its dividends is being paid out, of its free cash flows is being paid out as dividends. So it definitely does meet our criteria, because it's 70% of the money can be reinvested back into the company, because it's only paying out 30% of its free cash flows as dividends. So that's pretty good. Now let's see how consistently the company has been increasing its dividends over the past 10 years. Okay, ticker symbol POOL. So it has been increasing its dividends over the past 10 years at a rate of 14.98%, which is pretty phenomenal. Now let's see if it meets our buy criteria at the moment with its current valuations. Okay, so Pool's dividend yield is 0.68%, which is lesser than the average price to earnings multiple. So as a result, I wouldn't be considering buying the stock as a part of our dividend portfolio, because it doesn't meet our dividend buy criteria. But rest assured, let's have a look at the stock price when the dividend yield was meeting our criteria. In March of 2020, the dividend yield was around 1%. That's not that attractive, but in terms of capital appreciation, you would have nearly doubled your money in a span of 4 months if you had decided to invest in this stock at that particular time frame. But no worries, we can still see if it meets our dividend value proposition. Let's have a look at that. So Pool, the return on invested capital, all right, definitely more than 10%. Even at the lowest in past 10 years, it has been over 10. So it definitely does have some sort of long-term competitive advantage. The revenues we've already analyzed. We know it's consistent. The strong balance sheet part, let's have a look. So it has a total long-term debt of $438 million, and current assets of $1.137 billion. So the management is doing a really good job maintaining its current asset levels, and if it wants to clear off its long-term debt, it can clear it off instantaneously. So definitely a strong balance sheet. So it's 0 years for it to clear off its long-term debt. Now let's calculate its intrinsic value. So the earnings per share is 7.01, and the price to earnings range that it has been trading over the past 5 years is 23.78, 48.03, and the analyst estimates for pool stock is 17%. So the multiple we will be considering is 34, which is 17 times 2, which is lesser than the average price to earnings ratio. So we want to be on the conservative side. Looking at this estimate, we can see that the intrinsic value of the company is going to be somewhere around $979.20, and the fair price at which we should be buying the stock would be $278.35, considering a 15% return on your investment over the 10 years from now. And the margin of safety would be $139.17, at which we should be buying this company. And if you want to be entering the stock, we would be considering it if the stock price reaches around $222.68. I understand we did miss our opportunity here because it's currently trading at $330, and the last time that we can see for pool stock trading at these levels was somewhere in mid-March at the middle of the pandemic season, right? As a result, it definitely didn't meet the buying criteria at this stage. And now let's have a look at the rule number 5. So the price to earnings ratio must be 50% of the highest price to earnings ratio. We can see that the highest price to earnings ratio was 48, and half of that, 48 divided by 2, half of that would be 24. And it's trading at its all-time high, which is more than the S&P 500 index. As a result, we just missed the opportunity, guys, but there are still a few more companies left in this spreadsheet that we can go over to see if it meets any one of our criteria. Now, the next company in this list is Archer Daniel Midland, ticker symbol ADM. On the surface, food-related companies seemingly represented the best stocks to buy during the pandemic. No matter who you are or how much money you have, you need sustenance. Therefore, this sector seemed like a no-brainer. However, things just didn't turn out the way I envisioned. While companies like Kroger, Costco, and Target perform well, individual food stocks to buy left much to be desired. So if this resurgence turns out to be the dreaded second wave, I'm going with Archer Daniel Midland and ADM stock. As you know, Archer Daniel focuses on food processing and ingredients. They provide the solutions and components with all food manufacturers need to take their products to the market. With ADM stock, you're not banking on any one name, but rather the industry. That's pretty good. So moreover, Archer Daniels is particularly intriguing for those interested in plant-based meat companies, but don't want to risk the volatility of buying Beyond Meat shares. With ADM, you get exposure to the existing space, but potentially mitigate the wildness. Okay, so that is pretty good. So you're basically investing in the entire market rather than going for a particular stock because it's well diversified and the clientele that it has. Okay. The price to earnings ratio definitely at a discount when compared to the S&P 500 index. Let's see if it meets our dividend portfolio. So ADM. Ooh-wee. There's a lot of W shapes here. The revenue has been decreasing along with its free cash flows, and it has minus $28 billion, and it's paying out $789 million. What I think personally is that it shouldn't even consider paying out a dividend when it's not even able to generate free cash flows, positive free cash flows. As a result, I will be skipping this company as it does not belong in our dividend portfolio or our value portfolio because it's not even generating positive cash flows at the moment. Maybe it might need some time because there were some years at the back where it has been producing consistent cash flows of around $4 billion. But from there, it just went downhill from 2016 or onwards. So the next company in this list is K12 Inc., ticker symbol LRN. For parents with school-aged children, the novel CVPD has been a nightmare. Part of the hesitation of physically returning to academic institutions is the uncertainty. As Scientific American explains, children are widely thought to be at relatively low risk of developing severe CVPD, but a new report from the American Academy of Pediatrics, AAP, indicates that cumulative cases doubled in the past month, between July 9th and August 13th. The numbers increased from about 200,000 to over 406,000. Physically reopening schools might accelerate the increase, potentially raising the number of children with severe symptoms and spurring spread among the community at large. Ultimately, this crisis incentivizes online learning platforms like K12 Inc. To no one's surprise, LRN stock has been one of the top picks during the pandemic. With social distancing becoming the norm, K12 takes the concept to the extreme. That said, this is a bit of a riskier play among the stocks to buy this week. For instance, between early August and until just recently, LRN stock was in a downward trend, but that may reverse due to less than desirable outcomes as schools reopen for their fall semester. Okay, let's see if this company belongs in our dividend portfolio. Most of all, let's see the price to earnings multiple, 60.65, not at a discount when compared to the S&P 500 index. Now let's have a look at LRN. Okay, $1 billion in revenue, out of which it's able to get $35 million as in free cash flows, and doesn't pay out any dividends, so it definitely doesn't meet our dividend criteria, but we can still see if it meets our value proposition. So ticker symbol LRN. Return on invested capital, not about 10%, not looking that attractive when compared to all the other stocks. Okay, now we already analyzed this part. Consistent cash flows, I would say so. Yes. Strong balance sheet, has around $100 million in long-term debt, which can easily clear off with its $500 million of its current assets. So definitely a strong balance sheet instantaneously. And now let's see in the projected intrinsic value. So it's currently trading at an earnings per share of 0.61. And looking at the range for this particular company, LRN, wow, 20.08, 371.67. And the analysts are estimating the stock to grow at somewhere around 20%. So based on our intrinsic value calculation, the intrinsic value of the company is going to be $125.90 if everything goes well for the company. And the average fair price that we should be buying the stock is going to be around $35.79, right? And we want to be paying a sticker price or at a margin of safety of at least 80% below, at least 20% below the fair price of $28.63. Currently, the company is trading at a fair price of $36.55, which is exactly the share price, but we do want to be considering with the considerable margin of safety when we are investing in the stock. So as a result, it doesn't meet this particular rule number 4, but let's have a look at rule number 5, right? Rule number 5 is that it should be trading less than 50% of the highest price to earnings ratio. So the highest was around 371 price to earnings ratio, definitely a 50% discount, but it needs to be cheaper than the wider market. As a result, this company as well didn't meet our criteria. Now let's have a look at the next company. Wheaton Precious Metals, WPM. It seems like no matter what the market environment, gold is always risky. Therefore, you should take the idea of Wheaton Precious Metal being one of the best stocks to buy with a grain of salt. It's not that I don't believe in WPM stock, because I do. Rather, this is a sector that has produced much disappointment. Still, I hate to use this phrase, but this time could be different. For one thing, it is different. While we've suffered serious pandemics before, most notably the H1N1 pandemic of the late 2000s, we've never seen state and federal governments impose stay-at-home orders like this. Unsurprisingly, this imposed a hard stop on the economy, making WPM stock quite intriguing. Primarily, the doom and gloom prognostications, I don't know what that means, but that will shoot gold to 5-digit prices are just a tad more credible today. Frankly, the Federal Reserve doesn't have many monetary weapons other than to adopt as accommodating a policy as possible. Theoretically, this should be very good for gold. I also like Wheaton for its business model. As a streaming company, Wheaton doesn't have the direct risks associated with all or nothing mining projects. Okay. Let's see if this company belongs in our dividend portfolio. Ticker symbol WPM. Okay, so it has been paying out dividends. So the free cash flows are definitely a positive. The price to earnings ratio, definitely not on a discount when compared to the S&P 500 index. The free cash flows are positive. Dividends should not be more than 75%. Let's check that out. 0.129 divided by 498.41. So around 25% of this money is being paid out as dividend, while the remaining 75% of the free cash flows can be reinvested back into the business. But looking at the free cash flows, it hasn't moved that much considerably. Let's see, 150, 300, so around 10% increase. But there's a lot of fluctuations in the free cash flows. That's something that we might need to look out for. Let's see how long that WPM has been increasing its dividends. Okay, looking at the dividend history, it's only been increasing its dividends over the past. It has been paying out dividends since 2012, but it only has increased its dividends over the past 1 year. As a result, does not belong as a part of our dividend portfolio. But rest assured, let's see if it meets our value portfolio criteria. WPM 1.36, definitely not attractive at all when compared to the return on invested capital. And coming to the net consistent cash flow, we would say it's consistent, but it's not that much. But now let's see if it has a strong balance sheet. $640 billion in long-term debt and $180 million in current assets. So 640 minus 180, so it has around $460 million. Okay. $460 million, and if it does choose to pay it off, it would take around 1 to 2 years for the company to clear it off by considering the current assets levels. So I would say it's definitely a good balance sheet. Now let's see the price valuations. So currently the earnings per share is 0.786, and the range at which this company has been trading at is, wow, it's a lot, 19.64, 1035.52. I definitely wouldn't be going for this price to earnings multiple for sure. And now let's have a look at what the Wall Street analysts are saying that the company could grow at. 21.89, 21.86. So the fair price at which we should be buying the stock should be around $57, but we want to be considering at least a 50% discount on the sticker price, and it would be around $28. Since we're not getting at that particular price target, the margin of safety at which we should be buying the stock would be around $46. But I would be a little bit hesitant in buying the stock. I know that the fair price is really close, to the fair price, but we do want to be definitely taking a margin of safety, because the free cash flows over here, as we've seen previously, it's all over the place. It doesn't give us a consistent amount to show that, hey, you can either invest it as for its dividends or its value prospects. As a result, to be treading on the side of precaution, I would be avoiding the stock for now. Now, the next company in this list is Turning Point Brands, ticker symbol TPB. On the surface, Turning Point Brands seems a strange idea for stocks to buy this week, as the specialist in tobacco, vaping, and cannabinoid CBD products. Turning Point would be a relevant pick for any other circumstance. But during a health crisis, TBD stock seemingly risks extreme volatility. To be fair, this is one of the riskiest plays on this list of stocks to buy. However, TPB could also see significant upside thanks to its underlying consumer base. Particularly with its CBD vaping brands, the company could become the beneficiary of a panicked hoarding. That's exactly what happened with last year's vaping crackdown. Ultimately, Turning Point's second quarter earnings report confirmed the bullish narrative for TPB stock. The company delivered earnings per share of 71 cents, beating the estimates of 45 cents. It's also generated revenue of nearly $105 million, up over 12% year over year. Simply, people hoard products during emergencies. If things worsen with the CVPD, it's fair to expect more positives for TBD. Okay, let's have a look and see if TPB belongs in our dividend portfolio first. And moreover that, let's see relative to the market. TPB. 92, definitely not at a discount when compared to the rest of the market. Okay, it has been increasing its free cash flows. That's definitely a positive sign, but the free cash flows are fluctuating. But there has been a nearly 3, 6, 12, 24, so nearly 3 doubles. So basically the company has been increasing its free cash flows at around 30% year over year. That is pretty substantial, and so I would definitely say that the company has positive cash flows. Now let's see how much of the free cash flows is being paid out as dividend. 351 divided by 32.98, so around 10%. So the remaining 90% can be reinvested back into the business, so it's a good positive sign. Now let's have a look at TPB dividend growth history. So it's been increasing its dividends over the past 2 years. So the minimum criteria that we're looking for in order to meet our dividend portfolio is at least 5 years. As a result, it cannot be included as a part of our dividend portfolio because of its dividend paying history. Now let's have a look at the value prospects of it. So TPB, if you were to look at the stock, we already did the analysis. The return on invested capital is nothing but promising because it's 3.97. We're looking for companies that have more than 10, but let's look at the other fundamentals as well. So we analyzed this already. So only 10% of the dividends is being paid out as of its free cash flows is being paid out as dividends. The current assets has around $161 million. Total liabilities or long-term debt, $296 million. So 296 minus 161, it'll be left with $135 million, out of which I think that it should be able to 135 divided by 30. So around 4.5 years to clear off this entire debt. So it's okay. I would say that it definitely does have a strong balance sheet. Now let's see if it's trading at a suitable price for us to invest in. So earnings per share is 0.32. Let's see the price earnings price range. So 8.592, 105.47. So analysts do not have any growth projections for this company. So as a result, we can see that the company has been growing somewhere around 30% in terms of its free cash flow. Let's just consider a 15% growth rate. Even if we do consider a 15% growth rate, the intrinsic value of the company is coming around 33.77, which is already at the current price. As a result, we wouldn't be looking at consider buying this company at any of these valuations, either as a dividend perspective or as a value perspective. Now, the next company in this list is Chegg, ticker symbol CHGG. Before the pandemic upended our lives, Chegg was a very relevant platform. As you know, college education isn't cheap. Indeed, skyrocketing costs have made the student loan crisis a major political talking point. While investing in CHGG stock isn't going to change this dynamic on its own, the underlying business will probably become more vital. Primarily, Chegg provides a marketplace for students to buy, rent, or sell their books. As an inherently contactless service, students get their resources they need at a lower cost. Best of all, they can do so without having to worry about getting sick. For me, what makes Chegg stock compelling is its secondary services. As an online student resource and human tutoring portal, Chegg delivers help when students need it, even at odd times of the hour. Because, let's be real, there's no odd hour in college student life. Should the pandemic cause at least a semi-permanent shift in how we approach higher education, I see Chegg evolving with society. But for now, the uptick in school-related CVPD cases makes Chegg one of the stocks to buy this week. Okay, let's have a look and see if this belongs in our dividend portfolio. CHGG. Since it doesn't pay out a dividend, cannot be a part of our dividend portfolio, but we can still see if it belongs in our value portfolio. CHGG. So the return on invested capital is negative. As a result, I wouldn't even be touching this company, even though it might have some really good fundamentals, like in terms of its cash flows and everything like that. But we still want to be waiting this out because we don't want to be investing in companies where it's bleeding money at the moment, right? And the last company, I believe, is RHI, Robert Half International, ticker symbol RHI. So for the past 2 months, President Trump has raved about the record-breaking jobs reports for May and June. Technically, he's right. However, it's important to realize that we're talking about the percentage gains against extremely deflated comparisons. Presently, the unemployment rate is 11.1, an absolutely terrible statistic. But we all may get undeniable dose of reality for the July jobs report, because it may reflect the turmoil have been seeing for the past few weeks. The numbers probably won't be pretty. Yet, this also makes the case for Robert Half International as one of the stocks to buy. I understand that RHI stock has a stock D aura compared to a younger, sexier name like Fiverr. Nevertheless, I believe Robert Half offers advantages during this pandemic that its upstart rivals can't match. For one thing, Robert Half is about connecting workers to either consistent contract work or to a permanent placement. When everything is chaotic, many folks want measure of stability. RHI provides that. It's not too old to learn new tricks. For instance, the company lists many work-from-home opportunities, reflecting adaptability to the times. So that's pretty good from the management's perspective. Finally, RHI stock represents a hot commodity. In the pre-pandemic days, it was common for job candidates to ghost their prospective employers. You're not seeing any ghosting today. Okay, let's have a look at RHI stock. 16.91. At a discount when compared to the S&P 500 index, definitely. Now let's see if it does pay out any dividends to see if it meets our dividend portfolio criteria. So RHI stock, so I'm looking at it, I'm liking what I'm seeing here. So the revenues have been increasing consistently. The free cash flows, $140 million, 150, so nearly 15%, around 10 to 15% year over year growth, according to my eyeballing it. So definitely free cash flows positive. Let's see how much of the free cash flows is being paid out as a dividend. So 145 divided by 460, so 31%. So nearly 30% of its free cash flows is being paid out as dividend. So the remaining 70% can be reinvested back into the company, which is a definitely positive sign. Now let's have a look at the dividend history for this particular company. Ticker symbol RHI. So it has been paying dividends over the past 16 years at a rate of 9.96% growth rate. So definitely a buy. And now let's see, fingers crossed, if it meets our buy criteria. RHI. So the current dividend yield is 2.46 and the average dividend yield is 1.96. So it's a definite buy for us because it's trading more than the average dividend yield. So definitely a buy. So RHI stock. And the price for that. So dividend portfolio definitely. But rest assured, just for the fun of it, we know that it meets our dividend criteria and we should definitely be investing in this company. Just as a rule of thumb or just for fun, let's see what would have happened if you invested somewhere in March when the dividend yield was around 3.72%, right? Looking at RHI stock in March, the company has pretty good fundamentals as well. So $34 and now it's trading around somewhere around $53 per share. So you would have gone around somewhere around, let's just say 34, 35, 70. So around 80%, somewhere around 80%, I would say, returns just by owning this company at that particular point in time. Rest assured, we still know that the company has a long way to go and it should be able to recuperate this amount. Now let's see if the company meets our value portfolio as well. RHI. The return on invested capital, pretty freaking phenomenal, 41.16%. So hell yeah. Return on invested capital greater than 10%. Now the revenues and everything we've already analyzed, it's only paying at around 30% of it. So the net cash flows look pretty attractive. Now let's see if the company has a pretty good balance sheet. So the total long-term debt is $30.35 million or $350,000, and it has $1.72 billion in current assets. So definitely a good move from the management in terms of its long-term debt. Now let's see if it's at an attractive price to buy, if it's in the value proposition. So the earnings per share is 3.19, and let's see how the price to earnings ratio has been fluctuating for this particular company. So the price to earnings ratio was around some, okay. What is this? RHI. $8.762, 29.17. The analysts are estimating that the company should be able to grow at somewhere around 3%, so 5.4. So the intrinsic value would be 21.89, which is definitely lesser than the current price. So as a result, this sort of valuation wouldn't be sufficient. And if you were to look at the 50-year, 50% of the highest 5-year price to earnings ratio, it's not even trading around, somewhere around that, I would say, and definitely a discount. So let's have a look. So the highest of the price to earnings multiple is 29.17, right? 29.17 divided by 2, 14.585. As a result, it definitely does not belong in our value portfolio by using these strict guidelines. But rest assured, it does definitely meet our dividend portfolio, and I would strongly recommend that you should consider buying this company at this particular stage. Okay, so out of all of these companies, these are the two companies that met our criteria. So pretty happy, low stock, nearly trading at a 50% discount, and RHI stock is a beautiful dividend company that you should consider buying right now. So the closing remarks: a former senior business analyst for Sony Electronics, Josh Mato, has helped broker major contracts with Fortune Global 500 companies over the past several years. He has delivered unique, critical insights for the investment markets as well as various other industries, including legal, construction management, and healthcare. As of this writing, he is long gold and has a bullish options positions in XSPA. So he doesn't own any of these companies, but he is invested in gold, according to this article, right? So I hope that you guys really enjoy this and do your own little bit of research to see whether you want to be investing in these companies. I would highly recommend reading those 6 books that I mentioned previously, because they're a really good read if you're wanting to invest your money. What I believe is that investing in the stock market is the most passive investment opportunity that you can do when compared to the other asset classes like real estate and everything like that, where you do need to get involved here and there. But for companies like these, you just need to get involved in the beginning, and once done, rest assured everything can be managed by the company's management and everything by itself, right? So full disclosure guys, this video is for education and your entertainment purposes only. There is no guarantee that you will earn any money using the techniques and ideas mentioned in this video. This is not a financial advice. Please consult your financial or tax professional prior to making an investment in these companies. So if you guys have stuck around till the end of the video, make sure that you smash the like button, gently tap the subscribe button, and turn on the bell notification icon so that you can get notified as soon as we post videos. Until next time, catch you in the next video. Peace.